Welcome to this week's episode. I'm delighted to have back with me Stephen Liu, who is the CIO of the Blue Whale Growth Fund over in London. How are you, Stephen?
Very well. Thanks for the invitation, Andrew.
I think it's been about 8 months since we last spoke. We put out a podcast with you on February the 5th. I listened to that one again last week, and I had a little look at some of the mumblings and grumblings you had on your website, your correspondence with investors. So I think going forward 3 months to May, you provided an update for investors in response to the tariff impact. So a lot happened between February when we first spoke and then May. So at the time you made a few portfolio adjustments. For example, I read that you sold or reduced your exposure to Meta and Nintendo, the former for fear that it was vulnerable to, it exposed to digital advertising and therefore vulnerable to an economic slowdown. So with the power of hindsight, Stephen, what do you think about the health of the global economy in light of perceivably a US-led slowdown?
Yeah, thank you for that question or the reminder of what we have done early this year. Obviously, I think it's important to point out that we are in a very challenging macro environment as we go through the year, and we'll continue that journey into 2026 from here. And there's a lot of uncertainties, unknown variables, whether it's a Trump tariff coming into play, whether it's a slowdown in US economy, etc. And I do not think today, even though the market has recovered very strongly, that we are in a better position today than 6 months ago. So our view remains very much the same, that we are going to see a slowdown. Well, obviously probably not a severe recession, depending on what Trump and China is going to do on this 100% tariff, which have come out quite recently. But barring a scenario that's going to be a kind of like a mega trade war between the two biggest countries in the world, then I think a reasonable slowdown would come into play. And of course, the other thing just to bear in mind that while the tariff have not actually probably fit into the US economy yet, but it's going to come with a lag, which I think you can see some pricing or sticky prices that has been put through by retailers in the US at the same time as well.
Stephen, let's just focus really quickly on Meta and Nintendo. Are you content with the decision to sell both stocks?
Yeah, I think the two things going on, obviously very different part of the investment thesis or the decision. I think as far as Nintendo is concerned, I mean, we have owned the stock for over 4 years before we exited recently. I think the issue with Nintendo is not so much about the contents, the IP, the third-party games, which they have done very well, or the Mario, the Zelda, the IP, but it is about the Switch that they just launched, which is yet to come, right? The Switch has been launched now. But of course, the biggest selling season is going to be over the Christmas or over the New Year, which is now what we're going to tackle with. And if you think about the tariff and all that is not yet fit into the equation. So I think we're still being cautious about what that might lead to in terms of how many units they can actually sell. I mean, expectations are quite high just because the product is pretty good. But equally, I think you need to look at the fundamentals in terms of the actual delivery or the actual numbers that can sell to investors. I think as far as Meta is concerned, that is probably slightly different. I think it's partly related to our concern about AI spenders. So for example, within the Magnificent Seven, we don't own anything except NVIDIA. So we do not own the other 6. And Meta would feed as part of the equation that even though we love the data story, we love people who are still using Instagram, WhatsApp, and Facebook, very entrenched territory for data. But at the same time, they're equally investing a lot into AI. And we are just where we are in the cycle is we are very cautious on AI spenders. And we would rather to be on the receiving end of any AI spending, which would then include your likes of NVIDIA or Broadcom or Vertiv, that we want to see some tangible revenue or free cash flow generation rather than to be the contributor of that free cash flow that Meta or Microsoft might be generating today.
Stephen, with stocks that you've dispensed of, do you consider that to be like a permanent divorce, or would you ever return to Meta? Under what conditions?
Yeah, no, thanks for this question. Actually, something that we haven't touched on before was that I think one of the kind of the way we think about stocks is we never fall in love or out of love with companies. And we have done this before. And I think using Meta as an example was that we had exposure to Meta since we started back in 2017. We sold out of Meta in January 2022. And obviously that was a very different narrative at the time. Zuckerberg decided to go into the metaverse. We were very concerned about the metaverse, which now he stopped talking about. And then later on in 2023, while we were very much into AI, because we already got NVIDIA in the fund, we were looking for more companies that have exposure to the AI. And one of the things about AI is about data. And Meta has a very strong position in data. So we then decided to go back into Meta back in Q4 2023. And we have done very well since then, since October 2023 until recently. So hence, I think from an investor perspective, it's always about the investment thesis, about your expectations, about what you think is going to happen. That is very different to the market expectation. I think at the moment, the narrative is probably more one-sided in terms of the more money you spend, the more return on investment that you get, which is something that maybe we're not sharing at this stage. But at some point, if expectations are going to be reset or the valuation become a lot more attractive, I think Meta, in terms of the data that they have, is still very valuable in the context of AI. So I think that has not changed.
Back to May 2025, President Trump has done an awful lot in terms of reshaping everything. And one of the relationships that he's kind of picked at, pulled apart, changed, shifted is geopolitical tension, particularly with the US and the EU, and rebalancing that to a large degree. You had an elevated conviction that the path of EU defense spending would be higher. Do you still feel the same way a few months on?
Yeah, so there's this new term, obviously, coined by someone else, is called geoeconomics. It's basically economics that's tied into geopolitics at the same time. And I think European defense would be part of this narrative. I mean, we were very, I think, constructive or positive on European defense after Trump was elected late last year or early this year. I think the tipping point was the conversation between Trump and Zelensky in January, that basically, I think what Trump was saying at the time was that Europe need to have the capability themselves, and then US is not just going to be the one who is going to spend all this money on behalf of European Union. And of course, I think what you have seen since then is the companies such as Leonardo that we have in the fund that it's almost doubled in value within the last 9 months, and that's done very well. But of course, I think where we are a bit caution on is the valuation, just because when we think about European defense versus artificial intelligence, is that you need to have the actual delivery of those kind of defense equipments or the capabilities. Is not like overnight, you just put more GPU compute and then you get to come up with some use cases that are very intelligent and people can then use the ChatGPT more or something. So it's not like that, right? It's the European defense is very much operating in the real world. So hence, I think when you look at the valuation of European defense company, I think it's definitely a lot less attractive today. I mean, we have been taking profits. So we have been keeping our position unchanged after the shares has doubled in value, but unchanged versus the beginning of the year. So we've been taking profits. But I do believe that the journey, or in terms of the spending, is continue to power on. But of course, then it's about expectation. Is it going to all come in 2026? Is it going to get spread out between 2026 to 2027 or 2028? And of course, then the financial market would probably expect things would come a lot sooner than later, right? But if I think about in the context of many European defense companies, historically, you probably would consider them as quality deep value, just because they're a good company, but they're not growing in line with European GDP, nominal growth, mid-single digit. Deep value means very cheap. I think today, I would consider them as quality growth, just because when you look at the context of Leonardo, they're growing their top line in low double digit, and the journey could last for the next multiple years. So they're no longer in a deep value category just because they're now growing faster. Of course, the valuation would equally have reflected that just because the shares has doubled. So hence, I think the return profile that you might get from European defense will be a lot less versus the beginning of the year. But it doesn't mean they can't deliver. So they will just deliver a bit less. And hence then I think you need to size your position accordingly.
Stephen, you've always been a long-term investor. That's something I learned in our initial conversation back in February. And at the time you pointed to, you got to buy the dips. And that was before we had the dip. So I think you've stocked up further on NVIDIA in the AI space. Tell us what your current thoughts are on artificial intelligence.
Yeah, so on a very high level, that if you believe AI is going to change the world in terms of our day-to-day on a personal basis, on a work basis, then I think we are at the very early innings of the AI development cycle. And if you do believe that's the case, which is our belief, then there's only almost only two companies in the world that's at the core of this conversation. One is NVIDIA, the other one is Broadcom. And Broadcom does the in-house GPU for the big tech companies. And of course, recently OpenAI have trying to have a commitment with AMD, but I think AMD would be more of a sideline to the AI infrastructure conversation. So it's still two companies, which is NVIDIA and Broadcom. So that is our thinking. And this year we have done a lot better from Broadcom than NVIDIA, even though NVIDIA's share price has gone up probably over 40%, but Broadcom probably in the range of 50, 60%. I mean, it's up quite a lot today on this announcement that OpenAI has picked the chips to do the in-house GPU for some capacity. So that I think what investors need to be conscious of is the valuation of, let's say, NVIDIA is probably not very high. I mean, it's trading at around 30 times earnings PE, exactly the same as Microsoft and Apple. And if you think about Apple has been trading at 30 times PE for the last couple of years already, it has not been growing at 50% a year. But NVIDIA probably was growing at 50%. Going forward will be a bit lower, but still a lot higher, but still would be in a double-digit growth rather than a single-digit, right? So hence, I think NVIDIA is transitioning itself into more of a quality kind of the core of the AI story. So it'd be a bit like your Apple in a way that, it could still trade at a premium just because there's no one else to come to take up to offer alternative product. And then at the same time, you would, at some point, you will see replacement cycle that the big tech company who invested 2 years ago, in 2 years' time, they would need to replace some of the GPU compute and to make it more robust. But of course, what is important though is even though NVIDIA is unlikely to disappear because it will remain very much a core conversation in AI, but then the return profile from a shareholder perspective from NVIDIA going forward is going to be a lot less. And I think you already have seen that, right? That you compare NVIDIA this year return, which is 40%, is very good for most people. But I've just outlined that Leonardo has doubled in share price. I mean, that's gone up a lot higher than NVIDIA, for example, and Broadcom has done a lot better than NVIDIA. So I think you just need to remember that NVIDIA is not going to repeat what they did over the last 2 years, but can they still deliver a better return than the market if AI is real? I think the answer is yes. So you still want to have exposure to NVIDIA, but it's less, I would say it's not the no-brainer kind of investment you could have done 2 years ago.
Another company in your portfolio in the Blue Growth Fund is Visa. And that's very interesting. I've been watching MasterCard and Visa, and to me, they seem to struggle whenever cryptocurrencies accelerate in price. Yeah. It's like one's going to win. What are your thoughts on the whole digital payments arena?
Yeah, it's slightly complicated, I would say. That I think Visa and MasterCard has not done that well. I think they're a bit boring, I would say. I think what happened this year in terms of share price, I think fundamentals are fine. I think people are still very much, their business model is still very much entrenched in our day-to-day spend. I think they still have a lot of avenues to grow. I mean, they are still, to be fair, they're making a 60% margin, still growing the top line, low double digits consistently. I mean, there's something that it's not many companies that can actually do that, even though the share price is a bit lagging. But then you will expect that if they keep delivering what they're delivering now, the share price will reflect it in time, which is our long-term view on Visa, MasterCard, and Visa in particular today. But you're right, though, in the biggest disruption is crypto. The only thing that could destroy the business model, apart from China, obviously they're not in China, is crypto, right? If people then end up embracing crypto as a day-to-day, so you bypass the payment networks. But of course, I mean, that narrative has been talked about since, I don't know, last 5 years. I mean, that's not new news, still being talked about. But personally, I mean, I'm based in London or in the UK or in Europe. I have not seen a material uptake in terms of the adoption of crypto in on a high street, at least. I have not come across many places that I do probably spend my time on to accept crypto payments. So I think that journey is a lot more slow burn, just because partly to do with regulation, partly to do with not everyone are actually into crypto. I think maybe the younger generation, they might be, or the more technological kind of connected cohort might be more into crypto. I mean, I don't have a crypto wallet, for example. So I think I need more convincing until the point that, okay, maybe I could actually use my crypto to make some payment. But I think that is the thing that I would relate to AI, is that is a friction to adoption, which then it slows down the delivery. It slows down the actual value add from crypto. That is a friction, right? Whether it's regulation, whether it's penetration, that most retailers don't offer you the crypto payment option. But then in AI, so linking back to AI, there's almost no friction. No friction to adopt, to have more people sign up to ChatGPT, which you already have 700 million people, to the Office 365 Copilot or Google Gemini. There are many things, right? There's almost no friction. That's why AI has seen a much bigger acceleration only within 3 years. Or you can think about less than 2 years. But crypto has been around for 10 years. But still, it's not part of our day-to-day. So then you can think about, like, even though, crypto has gone up a lot, but there's still no enough tangible use cases.
Isn't it more likely that Visa will solve the problem than the crypto space will?
Which one?
Isn't it more likely that Visa, the company, will solve the problem in terms of payment flow than the crypto industry?
In what sense? I mean, Visa, for example, they do work with crypto companies.
Right.
They do work with certain platforms to facilitate that, right? So then if you speak to Visa and MasterCard, they don't see them as a threat, just because ultimately you still are connected, right? Unless you just have an entire completely different payment network only deals with crypto,
right?
Which I think it was very difficult to see, right? Like, if you think about like payment wallets, I mean, you probably have multiple payment wallets. You don't just go to one payment wallet. I think payment network is the same. And I mean, I was just reading, like, in the US, there's like 4,000 local banks, like 4,000 domestic banks in the US. And then for the crypto to work, you need to connect to majority of banks so that they can actually accept payment. I mean, that is not an easy task. Right. And if you can then plug into the payment network that Visa and MasterCard offer, then maybe you get a bit of synergies on that front. So you actually accelerate the adoption on that basis.
Yeah.
So hence, I think that's frictions that is always very important when you look at a new technology. And I think the people who are slightly probably confused about AI, trying to marry that with the tech bubble, was that the friction is actually very small, apart from availability of GPUs, which slash money that you can buy GPUs.
Yeah. Now, you're a long-term investor. That's something I learned several months ago about you. Stock market valuation, however, is another thing. You say buy the dips, but how do you feel about market valuation right now as we approach the next round of earnings at a time when there's the possibility of a protracted US government shutdown and a significant amount of layoffs that began late last week and over the weekend? What are you thinking about into the end of the year, Stephen?
Yeah, it's a difficult one, just because I think it depends on your investment time horizon. If you ask me what's going to happen in the next 6 to 12 months, it's very, very difficult to call out the market on that basis. But I think if you take a 3-year plus view, when you make investment, I think at least you have a bit more like a journey that you can sit tight and go through some hiccups throughout that part. But the way that I think it's important for investors to think about is when you invest into a company, not investing into a market. I mean, we never think about, okay, S&P, what's S&P going to do, the NASDAQ going to do? Of course, you have the correlation, you have everything is connected, volatility, but you invest into a company. If you invest in a company, the only question you need to ask yourself is, outside of the dynamics within the sector, whether they are taking market share, pricing power, and all that, is what are the impact of some of these macro uncertainties, the US government shutdown, the tariff, maybe a potential US-led slowdown, is going to impact the earnings trajectory of your holding, your company, right? If you say, okay, the tariff is going to impact the exporters from Europe shipping over to the US a lot. I mean, I just was reading about a pastor in Italy is going to see like 100% tariff if the US is going to import a pasta from Italy. I mean, then maybe you're not in a very good position, right? But then equally, there are many companies that we just talked about that they don't see the impact or material impact from some of this uncertainty. And ultimately, if you are investing into a company, not trading around a company, then the true fundamentals would win, which means that could be volatility in this coming quarter, like people just want to reallocate, reposition, a rotation, maybe take profits into the year end. So you're always volatility. But if you know what you're investing into, at least you know the fundamentals of the company that you invest into, that is not going to be correlated with the volatility or the headline risk, then that would be an opportunity for you to buy the dip, right? You buy the dip on good asset. You don't buy the dip on bad asset. And I think that's what we did at the beginning of the year, or maybe even during the Liberation, post the Liberation Day for a couple of weeks. And then you can see that the market then managed to, our companies alongside the market has recovered very strongly. So ultimately, you think about companies, you think about the true fundamentals, and volatility could actually be an opportunity for you to reassess for the valuation, because the valuation could become more attractive. But I think to be a contrarian, which is, I think another point I want to make, is to be a contrarian too early or at the wrong time is going to cost you a lot of performance, which I think a lot of people have a tendency to try to attempt to be a contrarian.
You've been listening to the thoughts and the philosophy of Stephen Liu, who's the Chief Investment Officer at Bluewell Growth Fund in London. To the audience, if you enjoyed today's episode, please remember to subscribe wherever you download your podcast from. Stephen, thank you very much.
Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction.